The stock market and the bond market are two distinct components of the financial markets, each serving different purposes and catering to various types of investors. Here's a comparison of the two. Stock market. 1. Ownership. The stock market involves the buying and selling of shares or ownership stakes in publicly traded companies. When you buy stocks, you become a partial owner of the company. 2. Returns. Investors in the stock market typically seek capital appreciation, increase in the value of their investments, and may receive dividends if the company pays them. Returns are generally more volatile than the bond market and can be influenced by various factors, including company performance, economic conditions, and investor sentiment. 3. Risk. Stocks are generally considered riskier than bonds. Their prices can be highly volatile, and there is no guarantee of returns. Stockholders may experience both substantial gains and losses. 4. Liquidity. Stock markets are known for their liquidity, meaning it's relatively easy to buy or sell stocks at prevailing market prices due to active trading. 5. Ownership influence. Stockholders typically have voting rights and may influence the company's decisions, such as the election of the board of directors or major corporate actions. Bond market. 1. Debt instruments. The bond market involves the buying and selling of debt securities issued by governments, municipalities, corporations, and other entities. When you buy bonds, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. 2. Returns. Bond investors receive fixed interest payments, coupons, at regular intervals, and they are guaranteed the return of the bond's principal at maturity. Returns are generally more predictable and less volatile compared to stocks. 3. Risk. Bonds are generally considered less risky than stocks, especially government bonds or high-quality corporate bonds. However, there is still a risk of default, particularly with lower-rated or high-yield bonds. 4. Liquidity. The bond market can vary in terms of liquidity. Some bonds, especially those issued by governments or highly rated corporations, are highly liquid. Others, particularly those from smaller issuers or with longer maturities, may have lower liquidity. 5. Ownership influence. Bondholders do not typically have voting rights or influence over the issuer's operations, as they are creditors rather than owners. 6. Diversification. Bonds can serve as a way to diversify an investment portfolio, as they often have a lower correlation with stocks. This can help spread risk. In summary, the stock market is focused on ownership and offers the potential for higher returns but with higher risk and volatility. The bond market deals with debt instruments, providing more predictable returns and lower risk but typically with lower potential for capital appreciation. Investors often choose between these markets based on their financial goals, risk tolerance, and investment strategies. Many portfolios include a mix of both stocks and bonds to balance risk and return.